Hey, what's up, guys? Welcome to another episode of Invest Iowa. Today, we're talking about lending, mortgage rates, all that fun stuff, but from another perspective. So, I'll let him introduce himself. His name is Kyle, but can you just give us a brief description of who you are and why should we listen to you?
Yeah, thanks for having me, Sebastian. My
Yeah.
name's Kyle Goldenfedek. I'm with Midwest Family Lending, mortgage shop in Urbandale. I have my house is out in Altoona, so I'm kind of all over the metro. But today I'd love to just talk a little bit about rates, talk a little bit about the overall process of buying a house and what that looks like from a budget perspective. A lot of people focus on the house itself, not necessarily looking at how does that fit into your overall budget? How does it fit into your plans, your goals? We like to look at it from a bigger picture, a bigger perspective, and truly understanding where you want to get with buying a house.
Okay. And then Family.
Midwest Family Lending. Yep.
That's the company that you're working currently for, right?
That's the company I'm working for, and I'm on Team Chedester.
Gotcha. Okay, we'll get into a couple more details of that. But for now, what is your background and how do you get into the lending world?
No one actually goes to college to learn how to be a mortgage lender.
Yeah.
I went to college learning how to do some financing, some marketing, some computer stuff. I kind of just got a rounded education at Loras College, which, is probably the best college, right, Sebastian? So go Doohawks. So anyways, one of those things that, the mortgage industry is something that you don't necessarily get into because you enjoy helping people buy houses. You get into the mortgage industry because it just you fall into it. I started off with working as a digital publisher, helping people just write books and put college stuff out there. I had nothing to do with mortgages, and it kind of slowly over time I got into Wells Fargo, which led me down the path of understanding the backside of mortgages, understanding people that were in default, helping those people to be able to stay in their home, helping them to refinance or re-amortize their loan so that they could afford their monthly payment, which kind of led into me wanting to get more into originating loans and understanding how can I help people buy those houses and get into the house in the first place as opposed to being on that backside. So I got into originating loans with Wells Fargo, kind of bounced around with a local lender here at a bank, and then my partner and I had gone to Vegas together. I'd actually met him through buying my first house. He was my lender, recommended to me by my real estate agent, and he said, someday I want you to come and work with me. And that one day ended up being about 4 months after we went to Vegas together. And ever since then, I've just kind of tag teamed with him, a great business partner. And we've continued to grow our business together. And Charlie Chedester has helped me out a ton, so I got to thank him.
Moving along, how long have you been doing this?
I've been with Midwest Family Lending. I've been there for about 4 years now.
4 years.
And total lending experience, including background, underwriting and things of that nature, about 10 years.
Okay, what are some things that you like about being a lender? Some things that you might not?
I like that I get to be on my phone all day long, and I have no reason not to be on my phone. So I'm constantly checking Facebook. I'm constantly working with my customers over the phone. I'm constantly texting, calling, emailing. I get to talk to people all day long. It's the best thing. I can have open conversations. I mean, my ideal world is that I've got so many phone calls and people to call back every day that I'm just on the phone all day long talking to them about how they can improve their situation, how we can get them ready to buy a house, how they're writing offers, how they're getting accepted offers, that they're moving into their house and they're living out their goals, their lifelong dreams.
That's awesome. I mean, it's the dream job, right?
It is for me. I mean, I love it. I've considered other alternative careers, and I think, why would I look at any of those? Those are all jobs.
So you love networking.
I love networking.
Yeah.
I'm 6'10". I tell everyone I'm 5'22" for the heck of it. I'm 6'10". Nobody knows, nobody is a lender that's that tall. No. I used my hashtag tall money man. It's fun, right?
It is. It makes you stand out.
My last name is Goldenfedek. It's 13 characters long. Nobody can say Goldenfedek, especially when they look at it and they see a P and an F next to each other. So when I heard that and I realized I'm trying to sell myself, I said, I'm going to be a hashtag. I'm going to be something fun.
Yeah.
Tall Money Man is a fun way to push myself out there while also tall money dealer, that kind of gets into some stuff that I probably shouldn't be
Yeah.
affiliating myself with.
That's a good marketing. So not so much for investors, but more for your general people. Could you give me like a little description of how you guys handle the pre-approval process? Oh, like if I'm a prospect, right? Like
Yeah.
I'm starting to get into this home buying process. Like I walk into you guys' office, and what's the process look like?
Yeah, so whether you walk in, most people don't walk in these days, right? Most people want to pick up the phone and call. They'll get my number from an ad on Facebook or from seeing their friend talk about buying a house. They're going to get my number somehow. And of course, my number is 319-850-2435. Got to get that plug in there. Feel free to text me, call me, whatever. I'm available 24/7. I'm not a banker. I don't work banker's hours, 8 to 5, 9 to 5, whatever that case is. I'm working all the time, and I'd love to chat with people to understand these concepts. When I'm looking at a prospect walking in, we change things up as far as how we handle a prospect compared to what I've seen done in the past. And that is, we do a survey to start off with all of our customers. We're going to ask, in that survey, we ask, what you want your monthly payment to be. What is too much for your monthly payment? I don't want to spend more than X. What you want your end goal. I want to purchase a home for X amount. I want a $400,000 house, but I only want to spend $1,000 a month. More than likely, that's not going to be possible unless you have a really large down payment. So that just leads into more conversations and truly understanding, is it your budget that's holding you back? Is it do you have that wine desire with the beer budget, whatever that, I'm terrible with analogies. But do you have those things in mind? And then we're also kind of just going through, where do you have your money saved up? How much do you have saved? We kind of go through a lot of the questions and really understand your financial picture. And then from there, we collect all your documents. So we're going to gather up your tax returns, your W-2s, pay stubs, bank statements, and your driver's license or photo ID. And we want to make sure that we can get you pre-qualified. So we'll pull your credit, but we're also going to review all those documents. Once we review those documents, we're essentially doing a pre-underwrite. By doing that pre-underwrite, we are going to give you a pre-approval letter. A pre-qualification versus a pre-approval. Pre-qualification is truly just pulling credit and saying, yeah, you've got a good enough credit score. And based on you told me you make $10,000 a month, and you told me you have $25,000 in your bank account. So based on those things that you've told me, yep, you can probably buy a house. That's what a pre-qualification letter is. If you go on Rocket right now, you can punch all that stuff in and they'll give you a letter that says you're pre-qualified. Pre-qualified doesn't really mean a lot other than I went through the process, I had my credit pulled, my credit's good enough. Pre-approved means I've actually had my documents looked at by a professional, and yeah, I can go out and I can buy that house. A lot of people mix those up, or they think that they don't need that.
Pre-qualified versus pre-approval.
Yeah.
So let me get this straight. So pre-qualified is what most bank institutions will give you?
A lot of places will give you a pre-approval as well. You just have to check your documents to see what they say. Some will only give out a pre-qualification.
And then a pre-approval is actually all of that combined when, yes, we're going to give you that loan.
Correct. So pre-approval is still somebody reviewing all your it's somebody reviewing all your documents. Yes, it's not a guarantee that you're going to get the loan, because there's still could be something out there that the loan officer doesn't know when they review your stuff.
Right.
But based on everything you provided to them, it appears that you can qualify. Now, the underwriter is the one that truly makes that decision. But until that point, I'm going to, we've done this long enough, and I stand behind my name that if I tell you you can go out and buy a house, I'm going to make sure that you can go out and buy that house. And if you can't, I'm going to also tell you that, so that way we can fix up your situation and get you in a position that you can buy a house.
That will make sense, especially Des Moines being such a small market. Everybody knows each other, and your reputation's on the line.
Reputation goes everywhere.
Yeah.
Yep.
So talking about Des Moines market, where do you see that going? Where are the worries from the financial institutions, credit unions? Like, where's that going in the Des Moines area? What's the conversation?
Yeah, I think that honestly, even looking at the overall picture of the state of Iowa, if we look at the number of loan originators that were licensed starting in 2022, we had 13,600 loan officers to begin the year. Beginning of 2023, we only have 6,500. 6,500. We have 49% of the loan officers that we had to start last year. Last year was a difficult year. I always thought I was in the top 50%. Now I know that I'm still in the top 50% because I'm still here. But in all honesty, I mean,
But wait. Why that drop though?
markets are difficult. Of course, we've got a lot of out-of-state lenders. You got Wells Fargo. You got Quicken. You've heard of all the different massive companies having layoffs and going through that. A lot of those people are registered or licensed in the state of Iowa, and therefore they have their license. Well, when big companies lay off a lot of people, there's less people that are licensed here. There's also just a lot of loan officers that are in town. I can think of a couple off the top of my head that have just chosen to go with other paths that are more stable. You know, being a loan officer, you are typically on some sort of a commission structure. It can be really nerve-wracking when the market's down. Now, on the flip side, you ask me, where are we at with the market and where are we going? I think this year is going to be awesome. I am so excited about 2023 because I think rates are going to get better. I think that we're going to see more people coming to market to sell their house because they've been in their house for a couple of years. People get restless. Yeah, they have that 2.75% interest rate. They love it, but honestly, they kind of want a bigger house. The rate was really nice to have it for a while, but I want a bigger house. I want something better. I got to keep up with the Joneses, right? So I think that you're going to see more sellers coming to the market. I think buyers are still going to be there. I read a stat a while back that said that about nationally, I think 1.6 million people are coming to market every year to buy a house, and only about 1.1 million homes were going up. That was a stat from early 2022. But homes are just not being built fast enough. Now, we've definitely slowed down in the number of people that are buying, but that also means that builders aren't producing nearly as many homes because they're not able to sell them either. They're also coming down on their prices recently. So ultimately, I think that 2023 is going to be a good year. I don't know that rates are going to get down to 2.75, 1%, whatever we saw before, but that's not really sustainable either. You know, when you were getting a 2% interest rate on your mortgage, you were probably paying the bank with your savings interest that you were supposed to be earning. So
pretty much
having a 5% interest rate means that you can actually make a little bit of money having, you know, interest accruing in your savings account. So it's really a better stabilized market to have high fours, low fives rates in that area. Right now, they're not quite there, but you know, a lot of the economists that we're following, they're saying that it's going to continue to lower, and you know, it'll spike every once in a while. It might have a week that it's bad, and then it gets a little bit better in the next couple of weeks, and it gets bad for a week, and it's going to continue to improve. So rates getting better, houses coming on the market, people coming ready to buy, all those things just lead to more competition in the marketplace, which is another reason to contact a loan officer sooner than later, because a local loan officer is going to be able to help you get qualified, get pre-approved, and get into a home before the spring market. Spring market, I think, is going to be nuts.
Man, you're great at talking. Do you do this for a living?
I try. I love being on the phone. I said that.
Okay, yeah, definitely. You will definitely convince me. If you were to call me, I will definitely consider
You ready
going.
to buy today,
Yeah.
Sebastian? Let's go. Let's get
so.
you a house.
All right, let's do it. Okay, that I think we kind of hovered way too quickly on the people that are coming into the market and the amount of houses being available. I was having a market update with Keller Williams Realtor. His name is Darcy Grantham, and the new houses that are coming into the market are on the 300 range.
Right.
And the people that are coming into the market, the majority of those people are looking for houses between the 50,000 to your 200K.
Yep.
So what are your thoughts on that?
I think the resale market is going to be there, but at the same time, you that is accurate. But then you're also seeing where, you know, our unemployment rate is still ridiculously low, and it's lower than what it needs to be in order to sustain a growing economy. So I think that the recession will more than likely allow some people to make enough money to be able to buy, but I think that's still going to keep a lot of people on the outside looking in, saying, "I want to buy a house, I just can't afford it," and there's still going to be an inventory problem. I think stat I heard last year was something about inventory is going to be an issue for the next 4 or 5 years, just because there's not going to be enough homes, and we continue to see a lot of people moving in. And that's the other thing, is in the state of Iowa, we're not necessarily always as drastically impacted by some of the things. We talk about 07, 08 being a really bad foreclosure cycle, and it definitely was for a lot of people out there. I don't want to downplay that whatsoever. But in the state of Iowa, it wasn't nearly as bad as it was out on the coasts. The coasts are ones that get hit the hardest on that. Now, on the flip side, this past year when the market was down and people were saying that there's not as many offers, Des Moines didn't necessarily see that big of a shock either. We still had competing offers on properties. I still talk to agents and they said, oh yeah, my $250,000 house had 10 offers on it. It still is taking place because it's in that price point that you're talking about, that I'm actually hearing like 150 to 250 is kind of that sweet zone where you put it out there, it's going to be gone in a hot minute. But under that, then you're also hearing about a lot of investors, your client, your customers here, that yeah, if it's lower than that, they're going to jump in there and take that as soon as they can.
Flip it.
There's too many investors in the market to not have those homes go quickly. So there's a lot of competition there as well.
That makes sense. So I had you do homework before. I had you do homework before we came into the podcast, and I told you, bring me some cool facts, bring me some cool stuff. What do you got for me?
Yeah, so I found that according to the National Association of Realtors, the monthly mortgage payment on a typical existing single-family home with 20% down was $1,840 this past year, 2022. That's up 50% from what it was in 2021. So that just speaks directly to the rates.
What was in 2021?
50% of that, less of that. So $1,200.
I'm not good with math. $1,200. Okay,
so
that
about
seems
$1,200 with 20% down. That's what your monthly payment was, and it went now up to $1,800. I saw people that came to me and said, Kyle, after COVID, things finally leveled out, and I could afford $100,000 house. Well, now with the interest rates the way they are, I can only afford $60,000 worth of house. I don't want to buy a house for $60,000. And oh, by the way, the values continue to rise. So a $60,000 house today is not going to buy you what $60,000 bought you 5 years ago. So the interest rates really had a grasp of these people, and especially the ones that said, I want to buy at the top of my eligibility. Those are the ones that, okay, your top continues to shrink because the monthly payment's now twice or 1.5 times of what you thought it was going to be.
Where do you think those monthly payments are going to go?
If I had a crystal ball, I could be a billionaire. I have no idea, but I can only think they're going to go down because we do expect rates are going to continue to come down a little bit throughout the year. So will they, numbers work out that math says that should be lower because rates are going to be lower than they were last year.
Who is going to be benefited from this? Your sellers or your buyers?
I think everybody benefits, depends on what your next situation is. So, for example, a seller is going to benefit because I think the values are going to continue to rise. Values are going to go up again this year. I saw another statistic here was that according to the Iowa Association of Realtors, Iowa housing statistics, in November 2022, unit sales of single-family homes were down 29.5% compared to November 2021, but not unexpected with a year-long rise in mortgage interest rates. However, overall, year-to-date unit sales is only down 9%. So we're still selling roughly the same number of homes as what we were the year before. I'm sorry, I totally lost my train of thought.
Let's break that down because that was a lot of information.
Let's go back to your first question. Go back to that before.
Yes. So who's getting the most benefit out of this situation?
I think the sellers and the buyers are going to benefit. Buyers are going to benefit because the interest rates are going to come down, so they're going to be able to afford more. Sellers are going to benefit because they're going to be able to get more money from the sale of their house because as interest rates lower, that means that people can afford more, so therefore they can list their houses for higher. As interest rates lower, we're going to bring more buyers to the market. More buyers means more competition. That benefits the seller because now I've got 5 offers. I can take the highest one. So the sellers are going to make more money. On the flip side, when the sellers go to buy the next place, they're going to be in that same situation. So that's another issue we ran into back in 2021 was that people would sell their house and they'd make a killing, and then they'd turn around and try to buy, and they would lose it all because they had to spend extra to get that next property. It might not be as drastic as it was in 2021, but I still think that's going to be the same case for 2023. buyers are going to be benefited because interest rates are going to be lower, and they don't have anything to sell, so they don't have to worry about. They might not get that benefit of selling something, but they're getting into a house. Hopefully, they can get in. And like I said, I'm pushing everybody to get in before the spring market comes, because when the spring market hits, that's truly when we're going to see a lot of people ready to move. People don't want to move in the winter. Iowa winters are not fun. How long have you been in Iowa, Sebastian?
For almost hitting the 5-year mark.
How is winter compared to Columbia?
Oh, well, there's no seasons in Colombia, so the winter is definitely just rainy. That's it. That's all we get, rain.
Yeah, it's not nearly this cold. So nobody wants to move in this, because typically, I mean, we're having atypical weather right now, but typically we're freezing. We're frigid.
Yeah.
And so when you got to go and you got to move all your stuff out of your house and move it to the next house, and you got to find a seller that's willing to do the same thing, people just are not motivated to do that. And so if you can go out there and you can be looking for a house now, you can more than likely get a steal. I mean, home values are not going up in the winter because there's not a lot of competition.
I think I saw statistics somewhere. Don't remember particularly where, but it says that the median close priced on a home during the winter at this point, during this 3 months of the winter, are the lowest that there is all year round.
I could totally believe it. Nobody wants to move in the winter.
Yep, that makes, especially here in Iowa.
And I'm pretty sure when I last sold and bought my last house was like July 15th, and it was like 90 degrees. No, it was 100 degrees that day. I'm really glad I paid for some movers that day, because that was terrible.
How long ago was that move?
Their money. That was 2015, so almost 8 years ago. 7.5.
Okay. Well, the market situation was completely different around that time.
It was. Well, that was the nice thing, and that's kind of what 2022 looked like. You could sell your house. You could have your house listed for sale. But you could also be out shopping, and you had some time, because even though interest rates were higher, that meant that homes sat on the market for longer. So, when I bought my last house, I went and saw it, and then we went and saw 3 other properties. We didn't necessarily like those 3 other properties, so we eventually came back to this one a month later, and then we had my parents come and take a look at it, and we had time to make that decision.
Parents are usually deal breakers.
Oh, my parents didn't really care, but I still wanted to get somebody else's approval besides mine and my wife. So, but in 2021, you didn't have that opportunity. You saw it, and your spouse might not even be able to show up, and you had to write an offer, because that's just the market we were in.
No inspections.
I do not want to see that again. No inspections is the worst thing for consumers, and I know that there's a reason for it, and at times, especially when you're an investor and you're just buying something you're planning to fix up and flip, an inspection really is can be a waste of time depending on the situation. But from a first-time home buyer that can't afford anything, and they're buying a $70,000 house, and that's the max their budget will allow them, and then they say they're going to waive that inspection, it breaks my heart.
Terrible. Yeah. I've had home inspectors here talk about that. Well, I mean, they say that it's very self-serving to say that they need a home inspection, but I don't think anybody in the right mind wouldn't consider a home inspection. It just can save you tons.
And I'd even throw out there that you should consider a home inspection when you get a new build. A lot of people don't think about that. Most people think that you got a new build home, you have your builder, they must have gone through all the right things. They had to pull the permits, they had to build the house appropriately. And yes, that's true. Most builders are really good. But having that home inspection is just another set of eyes of somebody who knows what they're doing, making sure that the T's are crossed and the I's are dotted. And I've had a lot of people say, oh, I'm really glad that I took advantage of that. It was $300 extra that I didn't think about. But you know what? It gave me a lot more peace of mind. And so when that warranty comes up in a year or 2 years, whatever that builder offers, there's not really many things to fix, because the inspector caught it all ahead of time and you were comfortable in your house ahead of time.
Right. That home inspection part is, I will always argue that home inspections are a blessing. But
never met a home inspector I don't like.
You want, as a buyer, you want a home inspector that tells you that the house is burning down. As a seller, I don't know, you'll like that, but
yeah, as a seller, you still get an inspection just so that you can find out all the things that are wrong, and you hope that same inspector goes back out after you fix all those things. It never works out that way, but
yeah, it's one of those things. But let's bring it back to loans. So now I would like to talk a little more about what does it look like at your workspace? So for your company, what was the name again?
Midwest Family Lending.
Midwest Family Lending. What is give me that elevator pitch for Midwest Lending.
So Midwest Family Lending is an organization started about 25 years ago, and we really care about giving back to the community. We care about supporting our community, supporting the local areas that we're in. As a company, we can do financing in Nebraska, South Dakota, Iowa, and a little bit in Colorado. However, I can only do the other three, so South Dakota, Nebraska, and Iowa, and mainly focusing on Iowa. But I really love to talk to people, especially people that are right on that border between Iowa and Nebraska or Iowa and South Dakota. They're not really sure where they want to buy. They have to talk to two different lenders because, well, one does Iowa and one does Nebraska or whatever. I love talking to those people because those are the kind of people that they can just relax and not have to worry about the mortgage lender. But Midwest Family Lending is a company. Like I said, we care about the community. We actually host or we sponsor a nonprofit every single month. So as a company, for as long as I've been there now, the 4 years I've been there, we've always had a nonprofit that we bring in each month. We do some sort of financial donation. We share all their stuff via social media, and then we also will try to volunteer our time, or we'll do our own, individual donations or whatever the case may be. But I've been introduced to a ton of nonprofits through my job. My employer is very adamant that we get out there and try to be involved in the community. I'm involved with a nonprofit called Able Up Iowa. I'm a board member, and I never would have gotten involved had I not been pushed by my company to be involved with the community, because I may never get a loan from doing that, but man, is it fulfilling to know that you're helping out others.
Correct. Yeah. So this is probably coming from my lack of knowledge about the lending world. How do you guys differ from a credit union? So there's...
Yep. So I'll jump right in here. So Midwest Family Lending is not a bank. We're not a credit union. We are a mortgage correspondent lender, which means that I will take your application, I will talk to you throughout the process, I'll work with your realtor, and then I will work with you all the way up until the day you close. I will be there at the closing day. From there, your loan does get sold to a secondary lender. It's the lender that I've found that makes the most sense for your situation. Maybe you're buying an investment property. We've got a place that's really good with that. Or maybe you're buying a house with 5% down. I can compare 3 different lenders to see who's giving you the best rate that day. I work with the different places to make sure that you go where it makes the most sense. And then your loan gets sold to them and they service the loan from there on out. Now, what makes us a little different is that we specialize in people that brain fart.
We'll cut it out.
I know. Let's see here. What makes Midwest Family Lending different is that we specialize in helping people to understand their overall picture. So we're not necessarily worried about making sure that you can buy this current house. We want to make sure that you can buy this house while also being happy, so that in 3 to 4 years or 7 years or 15 years, whenever that is that you decide you're going to sell that house, you contact us and you talk to us about buying the next house, or you want to buy an investment property while you still own that. We want to make sure that we look at your entire overall picture. We have financial advisors we work with. We have insurance agents that we work with. We have the people, the connections to be able to help you succeed. And so we don't look at just this as one transaction. I'm not trying to get you in the house and never talk to you again. I get you in the house and then I follow up with you. We make sure that we stay in constant contact. And now we've created a friendship, because I'm going to be calling you every once in a while, and hopefully we're friends throughout that process. Otherwise, it's going to be.
So if I go and I get your services and then I ask you to call me every Sunday night for like the first 6 months, you will do it?
I would sing you a lullaby every night before you fall asleep.
Okay, I think no matter where you go, it's the customer service and like how friendly you are with people and like helping without expecting something in return that brings more people to success, right? Is there anything that we're leaving out that I don't think I have mentioned? Because you're actually the first mortgage. What was it? You don't qualify.
Just call us a mortgage lender.
Mortgage lender. Okay.
So we're not a bank. We're not a credit union. You couldn't come to my office and say, give me all your money because it's going to be the $2.17 I have in my pocketbook. Okay. But on the flip side, one of the things we haven't talked about is, as a company, Midwest Family Lending, we offer really everything. I mean, we've got FHA, conventional, VA, USDA. We work with people, like I said, all three, Nebraska, South Dakota, and mainly Iowa. We work with people all over the place. We do a lot of the products out there. We do have a 2-1 buy down option that is something that's it's old. It's just come back into the market because interest rates are high. But it's a product out there. We have different products, different resources, and like I say, we have the connections. I've had people come to me and they have they have a really poor credit score. I can make sure that I set them up if they've got the other qualifications. They've got a bunch of money in their pocket. They just don't have the credit score to facilitate that. I can make sure to get them to somebody that does, that can do that loan. We have the connections. We pride ourselves in being connectors with the community and knowing other lenders and what they can do is so that if I can't do it, I can pass you off to somebody that I know can.
I think you'll be really good at answering this question for me. I think FHA loans are praised upon, right? Like, you think like 3.5% down, like, don't worry about it. You can buy that home. What are some negative things of FHA loan that people don't like? You never get the full picture.
I mean, everybody kind of knows that FHA comes with mortgage insurance premium, and so you're going to pay the PMI, private mortgage insurance. You're going to be paying that. You are going to have the sorry, now she was shaking her head at me, and I totally lost it.
I was just yawning.
Wow. Okay.
Trying to shake it off.
We're gonna.
Producer, please.
FHA is actually a really great product. So yes, there is mortgage insurance that's included on an FHA loan. Depending on how much you put down, you could have mortgage insurance for the entire life of the loan. That said, there are a lot of benefits. With your audience being mainly investors, I'm working with a gentleman right now who wants to buy a 2 to 4 unit property. Well, I can go up to 4 units at 3.5% down as long as he lives in one of those units. That's huge. A lot of people know that. A lot of people that are trying to be, creators and trying to disruptors, they know that they need to get into that house first, and then from there they can put a renter in at some point and move forward. But that 3.5% down on a $600,000 property is a heck of a lot nicer than doing, 25% down with a conventional loan. So FHA has its purpose. FHA is also kind of on the horizon. They have a bunch of different products out there that they want to bring to the market, and especially trying to help those that are maybe underprivileged or underserved, trying to get them into homes. I saw a graph earlier, and I didn't print it out, but essentially it said that over the last 22 years, so since 2000, the average debt ratio for an FHA loan has gone from, I think it was roughly 20% up to about 45%. So debt ratio is your total monthly debts divided by your total monthly income. It's gone from 20% all the way up to 45. Almost half of your income is now going towards the monthly payment of your principal, your interest, your property taxes, your insurance, your mortgage insurance, potentially your HOA dues. All that stuff gets roped into your monthly payment. 45% of your income is going towards your house. That blows my mind. I would be very insecure about my lifestyle if I had to spend half my money on the house. And by the way, that's gross. That's not your net income. That's not your take-home pay. That's your before taxes, before you pay your income taxes.
So how are people dealing with that?
Well, we're also looking at the highest credit card debt out there ever, I think is what I've heard. People are just putting everything on credit. So the nice thing is there's a lot of equity out there. A lot of people can take advantage of doing a cash out refinance. We can go out there and we can pay off a lot of your credit card debt. We can refinance your mortgage. Most people will say, well, I've already got a 4% interest rate. I wouldn't want to go to a 5 or a 6. Well, you might want to go to a 5 or a 6 on your house, knowing that you're paying off $50,000 on credit cards that have 30% interest. Now you're going to be able to foreseeably pay that credit card debt off. Whereas if you just say, I'm going to throw extra at your credit cards, run a debt snowball or an amortization calculator and find out how long is that going to take you to pay off the debt, because it's going to take a lot longer on 30% interest.
Wow. That's the more you know. That's crazy. So with the credit, so what are we looking for? a good credit score? Does it change depending on what the market is currently standing, or
Yeah, I think
stays the same?
no, the market totally has an impact. As the market has changed over the last 18 months or so, our automated underwriting system. So when we take your documents and we run it through an automated underwriting system, which is basically Fannie Mae or Freddie Mac saying, yes, this is an approvable loan based on the scorecard or the metrics that you've put into the system. We think, yes, we would go ahead and purchase this loan. Fannie Mae would purchase that loan. Well, if Fannie Mae would have purchased that loan and with a 640 credit score, they might have done that back in 2021. Well, because of risk being higher, they're now saying, well, 640, you don't have enough extra money sitting in your bank account because we're worried that, that recession is coming. So we think that you actually need 8 months of reserves instead of 4 months reserves. And so it has gotten harder, and that kind of changes as the market changes. However, right now I would say the higher your credit score, the much easier things are. Also, the lower the interest rate. But, standard policy-wise, I think conventional, most places will go down to a minimum 620 credit score. FHA, they'll typically go down to a 580 credit score. USDA and VA don't technically have minimums. Typically, they'll still follow that 580, 600 range, somewhere in there. But depending on your situation, if you have a bunch of money stored up, if you've got a bunch of reserves in cash, you might be able to get away with a lower credit score. So, and FHA actually will allow it as well, because now they've changed their model on how they do things, and they'll actually average your credit score with your partner's credit score when you go to buy a house, which is kind of cool.
Partners, you mean as someone who is related to you,
right?
By law,
right? Potentially. I mean, it could be me and my girlfriend.
Okay.
But it's somebody who has a vested interest in that property. It could be me and my parents. If they've got a great credit score and I have a poor score, we can average the two of those together and get you into that house based on that.
That was very useful information for everybody out there that feels like they're ready to make their first move, especially being so optimistic about 2023. Once again, I can't not emphasize this enough. This is not legal advice. This is just conversation, ideally to get you to a point where you better understand how loan officers work and how mortgages work and how to take advantage of all of those things. How can we get in contact with you?
Yeah, we've talked about a lot of stuff today, and I've really gone over a lot of it high level, and I've gotten granular on a few things. But if you have any questions, I would love it if you would shoot me a text or give me a call. My number 319-850-2435. Again, Kyle with Midwest Family Lending. Or you can ask for Tall Money Man and call the office if you want to. Actually, you can just Google #Tall Money Man, and you can find all my contact information there. Quick story. I used to have a massive sticker on the back of my car, and it said #Tall Money Man. And that was when I was driving the car my wife now has. So, of course, when she took it, she said, "You're taking that stupid thing off." But I loved it. And we're driving down the interstate on Highway 80, and a car goes flying by me, and I saw it had like Massachusetts license plates or something completely out of state, right? And I'm just putzing along. I'm a father. I'm in no hurry. I'll get there when I get there. I drive like an old man. And suddenly these people, they start slowing down. And I think, what in the world is going on? And I pass them because I'm on cruise control. I pass them, and then they pull right up next to me, and the guy takes his phone and he sticks it up against the window, and it's my picture. He Googled #Tall Money Man and found me on Google and was showing me my picture. So
it can be a good thing and a bad thing.
It was hilarious. And my wife and my kids were sleeping, so I got to enjoy it by myself.
That's very... Do you still have that?
The sticker?
The sticker in your car?
No, my wife has that car now, so she said, "You're taking that off." Like the day that she considered taking the car back from me, she removed that sticker, or she told me to. So
sad day.
Yeah, it was sad. So now I'm thinking I need to get, I need some help with advertising. Actually, I need to get a little sticker of some sort, maybe like the 26.2, but then it's like just a Tall Money Man, or I don't know,
something casual.
Yeah, something that if I cut you off, you might not have seen it because it was so fast, but not big enough that you know exactly who it is. Yeah.
Well, that's all we have for today. So the call of action is, if you find this useful, subscribe, hit the like button. It always helps us, and it makes us feel like we have support from you, especially from the Des Moines area, the Des Moines Metro. Kyle, thank you so much for accepting this invite. I really appreciate all your input, and I am looking forward to seeing you in a future episode to see how 2023 actually did things for us.
Thanks for having me, Sebastian. It's been a pleasure.
Bye bye.